as we're walking down the income statement to analyze that, income taxes have a material impact on a company's performance. There's a lot of different components to that. So let's just take a look about what financial statements are impacted by income statements, because it's not just the income statement, but it impacts the balance sheet and the cash flow statement. So if we look at that, the income statement is income tax expense, which is expressed as $1, and then it's explained in the notes to the financial statement, and you compare it. You take an analysis and go from the statutory rate to the effective rate. We'll look at that in a moment. On the balance sheet, you could have current taxes payable or receivable, deferred taxes payable or receivable. On the cash flow statement, it's changes in working capital for current taxes payable or receivable and deferred tax items. So all three of our financial statements can be impacted by taxes. The first thing we have is the determination of the current period tax expense, because we're looking at a period, so it's this determination. The first thing is the pre-tax income of a firm is based on either U.S. GAAP or IFRS, depending on which method you're using. But you start with the same base. This is not taxable income. Taxable income is a different concept because some items are treated differently for book and tax purposes. And that goes back to when we were looking at the policy impact of taxes, trying to incent certain behavior, to cause certain behavior to happen, or to penalize certain behavior. So we have some items are treated differently for book versus tax. And these items can either have a temporary impact, meaning that you may depreciate something for tax purposes over 5 years, and for book purposes you depreciate it over 10 years. So after 5 years, you won't have a tax deduction, but for book purposes, you will have a deduction. So those are what we'll call temporary differences. Is there timing differences? And then there's the permanent ones. And the permanent ones are not generally deductible for tax purposes, period. They just don't come back. And then there's the other ones that I started talking about. They're reported in one period for accounting purposes and different for tax. There will be a tax expense or benefit in one period when the deduction is taken for tax purpose, and then reversed when it's taken for book purposes. A lot of this is around the area of depreciation and amortization. That's where most of this is. That temporary item generates deferred taxes, which is a liability, and it can be classified as will it reverse within a year or will it reverse in a period greater than a year. So these are some of the concepts that we have. Key for you, pre-tax is how it's computed based on GAAP, which is in taxable income. Some items are treated differently for book and tax, permanent or temporary. Let's take an example here so you can see it. Book taxes, we start here. This is pre-tax income year one. I'm assuming a depreciation. We start out with this $1 million. Now we can take an additional $100,000 of depreciation over that which was recorded up here in pre-tax income. So the taxable income is $900 because I used an accelerated depreciation. If I start at a tax rate of 21%, the tax on the book would be $210, but my actual tax return is only going to show tax due of $189. So when we do the entry, we're going to debit tax expense, credit current taxes payable, credit deferred taxes. Now, let's assume that in year 2 and beyond, let's just assume it reverses in 1 year. Since you're not going to have that deduction, your taxable income is going to be $1.1 million higher. So at that case, it's $210 is the tax expense. That hasn't changed in this example, but the taxable income has. So in that case, you would debit tax expense for 210, debit 21,000, which is the deferred taxes, and then credit taxes payable. So these are what we call the timing differences. And going back to review that, why is there a book tax difference? Is the tax code is written from a policy perspective to get people to engage in capital expenditures or do something else. Other times it's to raise taxes or to discourage behaviors. It's not intended in any way to reflect economic reality of matching income and expense, which is the basis of accounting as we know it today. So we got to look carefully at it to see whether the company is performing on a pre-tax basis, and then look at it in an after-tax basis. You'll oftentimes will see that performance of a company is not necessarily driven by increase in revenues or by revenues. It's either cost reduction or the taxes get in there. Those aren't sustainable. The only thing that's sustainable for a company is continued revenue growth, given you keep your costs in line. This is just an example of what you see in a 10K. In note 4, this is for Steel Dynamics, of course. You can see that they break out. Here's the current income tax expense and deferred. So total income tax expense. This goes back to the income statement. But this is the key. One of the key things is right here. This is the reconciliation of the statutory rates to the actual effective rates. So it starts out, here's the statutory federal rate. 2018 it was 21%, but prior to that it was 35%. Okay? And then it's adjusted for state income tax, impact of tax reform, other items. But if we're looking here, the explanation is there, but the tax rate went from 36.2 in 16 down to 13.8 in 17 as a result of the Tax Cuts and Job Act of 17. It reduced the statutory rate right here from 35 to 21. So we have we took the benefit of all those deferred taxes, which were computed using the 35, have now been revalued at 21. So we see this is a big number, so we got to look at this when we look at the financial income statement. Now, the deferred taxes on the books as of 12/31/2017 were computed based on this 35% because it happened in the past. They were revalued using 21%, thus producing this benefit. And that'll be in a lot of our companies. And as we go forward, we're going to have to say we want to use and see trends, so we may need to adjust that. They then break down everything that you need to know, what the deferred tax assets are, and what do they relate to. Some of them are deferred tax assets, and others are deferred tax liability, giving us a net liability. And as we can see, the biggest one is property, plant, and equipment, which is all depreciation. Okay, so we find in the notes to the financial statement everything you need to know, but you got to read it. Okay, so when you're looking at Project 2, what you want to do, read this section, interpret it so that we can understand taxes. They then do reconciliations so that we can see the balances of the tax benefits. So that's the basics of what taxes is. Now we're going to take a few minutes and go through this taxation overview to give you more depth on